So what we have here is pretty, as usual, it's a pretty messy chart. But what we have is I've taken all components of the S&P 500 and scored them using my ranking system, and then taken the median score. So this black line in here is the median of all 500 tickers. Okay, and in each individual color. So this one is financials, so it's all of the components of financials. So in any given sector, something like energy has just under 25 names, I think, 22, 23 names. The big ones are financials, industrials, and tech. So they have anywhere between 60 and 70. Discretionary is quite big as well, but it's the median score. So it's the median score taken across each of the tickers in the sectors. Okay. And the point I want to make now, it's not that I'm trying to say that we're going to crash from here. I'm just saying we're at the polar opposite, actually, to where we were in October. Okay. In October, we had almost everything was at a depressed level where it wouldn't take much strength for all of the individual timeframes when we combine them together. This is a combined score. Okay, this takes multiple timeframes into one score. It won't take much from a depressed level for any given string of days, of positive days, to cause all of the different timeframes to catch positive momentum. Okay, and that's kind of where we are now. It's that everything has moved up and higher. There obviously, as there was through this period, energy was not necessarily outperforming, but its signal strength was coming from a higher level than the rest of it, whereas energy now is quite depressed. But it won't take much for a string of consecutive negative days to combine, because all of the individual time frames, 1 month, 3 months, 6 months, are all at strong levels. So it won't take much for a string of negative days to have a large impact on the combined score, because each consecutive bad day will count 3 times. Okay, because all of the different time frames are all coinciding together, so it will compound on itself. Okay, whereas here, as it compounded to the upside, now where we are here is actually the complete opposite to October. So yeah, you're starting to see it. You're starting to see it in other places too, not just in this median signal strength score, but across the, where the tickers are in relation to their momentum and trend levels. So when we look at the momentum and trend, or the distance to it, you can see that over the last, definitely since October, everything was up and to the right, up here, above trend, above momentum. And now almost all the sectors are somewhere in between. They're all kind of around the datum, right? There are some things above, there are some things just starting to weaken and fall below momentum, and there are others that have fallen below both. And that seems to be across the board. Now, of course, like anything, there is rotation. So, like anything, from a low, things tend to have a low here. Then the first thing that it's going to recapture is momentum. Then it's going to recapture momentum and trend. And then, if the cycle works as it should do, and there's not big big jump moves, i.e. earnings, etc., or dislocations for whatever reason it is, it tends to go in this cycle. And of course, the levels that equal capturing momentum or capturing trend are moving with the price, so they're constantly shifting. It's not like a level, it's not like an all-time high. Like an all-time high stays at that point. A 3-month low will stay at that point until as that 3-month window is moving through time. If it falls out of the end of the window, the new 3-month will be somewhere within that data set, right? So these levels are constantly shifting, and the price is shifting around them. But the point is just like the previous set of data, whereas before most things were up here and to the right, meaning above momentum and trend, now everything is slowly kind of floating towards the datum point. So there's much more within each sector. There's much more dispersion, if you like. There's some things doing well, there's some things doing poorly, and there's some things in between. Okay. Like I said, it's pretty much across the board. What my job is to try and see, well, which ones are going this way, because energy as a whole is kind of the same, is across the board, but there are certain sectors, there are subsectors within energy, the refiners, that are doing well in comparison to the others. So obviously, as the price of oil goes down, the refiners, that's their input. So if the delta between the cost of the inputs, i.e. crude, and the selling price of their outputs, which is gasoline and kerosene and all that other stuff, if the delta is widening, then for them, the refiners, they're going to do relatively well in comparison to the producers, etc. So that is one subsector of energy which is doing relatively well. Financials as a whole has been doing well. By far, the insurance sector was leading. That slowly rotated in like far more broadly across the financials. A lot of the regional banks and larger banks have overtaken those, but we'll see how that plays out. And actually the re-rank, but we'll see if it's good or not. But the re-rank has pushed quite a few of the larger banks like JP Morgan, etc., and Citibank into the top 50. So with earnings coming up, that could be good or bad. Who knows? We'll see. But yeah, it's kind of the same theme, that just like within any rotation, with any cyclical system, whereas before in October we were coming from a point where it was very hard for anything, at least on those two shorter term ones, 1 month to 3 month, it was very hard for things to get any worse than what they were. And right now, on the shorter ones, on the 1 and 3 month, that's completely flipped, and it's now to the point where it's really hard for it to get any better. So whether that comes through as some overall broad market movement, or through this, we need to look at any dispersion in the market, like what is coming down here and what potentially is staying up here. And that's what this system ends up doing. A lot of the names that we've been capturing more recently with quite big gains, 15, 20, 30% gains, those were all started during the weakness of October, leading into the October low, I should say. We had names that were picked up and were completely uncorrelated to the overall market, to the S&P 500, where they weren't at double-digit returns at that point, but in comparison to, let's just for ease, let's just say the SPY, okay, those names were up 3, 4, 5%, while SPY was down 10%, right? And then as the strength came back in October, around Halloween, yes, there were other things that outperformed in terms of, but those were coming from like really, really weak positions. So then the gains that we had through that period of weakness, we weren't showing big, huge losses because, our levels in terms of trend and momentum got us out. There were periods of time where we had big chunks of cash, yes, of course, but we weren't riding things down and taking losses on them while the market was showing weakness. We were keeping hold of the things that were showing strength, which put us in a position to firstly hold those right the way through, so we weren't seeing big drawdowns, but at the same time then we could recapture the overall market strength on the backside because we had cash to deploy and our signals told us when we could get back in.